Okay, assuming your company purchase a truck. Okay, this is in your book. Let's go step by step. If you have a book, I need you to go to the back, all the way to the back, okay, to the appendix. Let me give you my page. Okay. Appendix A-2, A-1 or A-2. This there's no page number. Okay, the page number is A like apple. A-2. You can use financial calculator, but I assume probably you don't have that. All right. In your book, A-2. Okay, assuming we are using the book 6th edition. Okay, 6th edition. All the way in the back. All right. So let's keep this page available because we need to come back to this table. Okay, we have two examples. Okay, two examples. The first one is on certain day, your company purchase a truck. All right, and according to the agreement, your company will pay a lump sum, say 200,000 in this example, for 2 years. All right, so just give you one example. So just give you one date, okay? This book is January. Two years after, so 2 years after this is. Purchase a truck or equipment whatsoever. So let's go step by step, okay? According to, oh, by the way, this is not really the real life, okay? The second one is more like real life. This one just assumption. I never seen this deal. So, on the day of purchase, your company received the truck. How would you enter into the accounting T account? Oh, by the way, I missed one information. Assuming the interest rate is 12%, it's 12% in this book, and keep the same rate for 2 years. So this is not that simple, okay? This is not that simple. You don't enter into 200,000 value. Understand? The truck value is not really 200,000 because that is the amount your company is going to pay in 2 years. But we all understand that this is 200,000 including interest, right? So everybody, give me the idea. On the day of purchase, how would you enter into the T account? So let's pick out, by the way, there's no cash at this moment. No cash payment right now, nothing. So you're gonna pick out one asset account that's called truck, right? Or equipment. Again, for this example, let's leave alone depreciation issue. We will not get involved depreciation. We just enter into the payment issue. All right, everybody. Give me an idea, everybody. We want to pick a truck, but what's the value of truck, by the way? What's the value of truck? Truck is assets. And if you really want to use that, this is on the A-1, page A-1. So what's the present value factor of the single payment? 12%, 2 year. So So you find out 12%, 2 year. Everybody see that? Page 8-1.
0.79.
Yeah, 0.7972. Everybody follow me? And this is the number calculated by the financial calculator. If you have or 1 divided by 1.12, square, same thing. All right? Everybody follow me so far? Well, I just want to go very, very slowly. Yes.
When it says period, is that 1 year?
Okay. This is 2 year, by the way. Everybody follow me. 12% if only 1 year, that's 0.8928, right? 29. Everybody understand? But for our example, this is 2 years. So you see 12% go to period 2. So you found out the number is 0.7972. I want to go very slowly. Okay. Everybody got that? So the present value of 200,000 at the rate of 12% per year for 2 years, that's a 200,000 times 0.2972. So the number here is 159,440. Again, okay, if you don't understand, raise your hand. I hope, we only have very few people sitting here. I hope everybody get the idea. Okay, you spend the whole morning here, the whole morning here. You spend the morning here. Okay, I don't want you to come here for this morning for nothing, okay? You learn something, okay? So the reason why you cannot enter into 200,000 under the assets, because the value of truck, it is not 200,000. It's only 159,442. Yes, go ahead.
Enter the value not at the sale time, actually, it's at the end of the 2 years.
Yeah, let's go back. Yeah, let's go back to his questions. Very good questions.
Which page is on?
Page on your.
Oh, on my book, sorry about that. This example is on page 479. Sorry about that. I keep on telling you A1, A2. I did not tell you the example. 479, everybody. Yeah, I want to go to Daniel. Daniel's questions. Very good questions. Daniel just asked me why we don't enter into the value on the purchase day. Eventually, we are enter the value of the purchase day. We are. The reason why we don't want to enter into 200,000 because 200,000 is not paid today. Understand?
Yeah.
As I said to you just a while ago, if you receive $1 year after, it is not $1 today, right? Same thing. If your company is going to pay 200,000 in 2 years, the value is not 200,000 for today. Everybody follow me? So Daniel just asked me the right questions. Why don't we enter the value for today? Because we don't pay today. That's the reason why. We pay 200,000 in 2 years. So if we convert 200,000 in 2 years to today, and based on 12%, of course, I cannot imagine, interest rate is so high, but assuming that is true, we convert 200,000 in 2 years, convert to today, really mean your company pay 159,440 for today. So the value of the truck for today, you enter into 159, am I right? 159,440. So this is the value. So this is the value of the day your company is going to enter into. But how about the other account?
So which means the value is 200K, but company today only pay 159,440.
I still would like to correct you. The value is never been 200,000. The value of the truck is not 200,000. The value of the truck is only 159,440. And the reason why your company is going to pay one time 200,000 in 2 years because they include interest. They include interest. So everything more than 159,440 up to 200,000, that portion eventually considered as interest expenses. It's not the value of the truck. Got it? But how about right now? You want to pick another account to match this. And for some reason that, yeah, you want to
No,
do what?
Liability.
Yes, liability because you never pay yet, right? Liability, so you just match note payable. I want to leave it alone because I want to save my time. So far so good? Because you need to match 159,440 on the credit side. So that is called note payable. Note payable is under the liability. And again, to simplify everything, we leave alone depreciation issue, okay? Because don't forget, as the accounting people, you need to do the depreciation every year. But we just leave the issue alone. We don't talk about right now. All right, so far so good. And then you just keep the truck and never pay anything. And also we leave depreciation alone. But how about interest? How about interest? Even though on the date December 31st of the first year, that is the first year expire. Even though your company has not paid anything yet, however, this is accrue method. This is the accrue method, right? So for your financial accounting, you need to enter into your interest expense. I want to stop here for a few seconds. Any doubt, any questions? Because I know some student may ask me, what the heck? You have not paid yet. How can you recognize expense? But again, for financial accounting, under the GAAP, we are not talking about cash method, we are talking about accrue method. So even though your company has not paid any penny yet, but under GAAP, you must recognize your expense. Doesn't matter you pay or not, because you obligate to pay, even though not right now, but later on. All right? So we all agree, okay? We will follow our GAAP. So by the end of the first year, we need to calculate the interest, but by how much? How much? How much? This is the number on the book.
200K by 12%.
Or, yeah, we have a debate here, right? You're gonna use 200,000 to calculate interest or 159,440?
The value.
Yes, 159,440. Again, you know, just like Andy just asked me, right? The value of the truck is not 200, everybody. The value of the truck is not 200 because we try to struggle right now. We try to sitting here, we try to struggle. What's really the value of the truck? Again, the value of the truck, it is not 200. 200 is the lump sum, total number your company is going to pay in one time in 2 years. All right, 200,000 is not the value of the truck. The value of the truck for today, or the truck, not, well, okay. The true value, let's put it this way. The real value of the truck is 159,440. So we use 159,440 times 0.12 for the first year, right? So we see the number is 19133. Everybody follow me so far? So you want to report this is what? It's what?
Interest expenses.
So we have a number already. 19133. But which account? Yes, you can pick out interest expense. Don't be afraid of. Doesn't matter, right? Under the GAAP accrue method, doesn't matter you pay cash or not. You recognize expenses. Big deal, right? It's good for your company. It's good. The best thing is like this. You have not paid cash yet, but you recognize expenses. So you have an interest expense. Am I right? Am I right? How about the other account to match this? The other account to match this. What's that? It's this number, but
Notes payable.
which account?
Notes payable.
We don't use notes payable. We use what? Interest payable.
Interest payable.
We don't use note payable because note payable is only 159,444. That number fixed already. It's another payable. Another payable is called interest payable. And everything you see payable, that's liability. That's liability. You see, we have an expense account matched with liability account. So as I said the other week, right? For each entry could be so many different kind of combination, no limitation. Could be assets to assets, could be assets to liability, could be expenses to liability here. All right, this is the end of the first year. How about the second year? Before we pay off 200,000, you need to do another thing. Do it again. But right now, the interest is 159,440 plus this number time 012. Understand? Because this number never paid. So the interest applied to as a principal. Understand? As a compound. Understand? So for the second year, interest expense is this number plus this number times 12%. Everybody can find me the number? What number it is?
1429.
Let me find. 21420. Okay? Am I right? 21. So for the second.
19133. I think it's calculated.
Oh no, use book. Okay.
Yeah, we used to.
21420.
429.
21429.
Yeah.
Okay. By the way, those two numbers will not be come together. Understand? Because for every expenses account, you will be closed by the end of the year. So right now on my board, I just put them together. But in real life, those two numbers will not meet together. Understand? Everybody follow me? For each expenses account, by the end of the year will close up. So at the beginning of the second year, this becomes 0. So we just enter this. Okay. However, this number will meet together. All right. For liability is balance sheet, right? Balance sheet is continual account. Understand? So this number will be here. So far, so good, right? Then your company pay 200,000. Everybody, help me to close this. When your company pay 200,000, you do what? You do
Increase the cash.
yes, cash account. All right. No problem, right?
Yeah.
All right. What about the other one?
Interest payable. Note payable.
It was
159,440.
and here you have total 200, right? You have 159,440 here. Apply to the principal, or say the value of the truck. Another thing is, what's the total number here? Am I right? Let's see the book. If I put any wrong number there, please correct me. And those numbers add together must be 200,000 or close enough to 200,000. So let me pause for a few seconds. Okay, everybody okay? As I say, if I put any wrong number there, correct me. Yeah, go ahead. Any questions?
19133 is in the book says 133. I'm looking for.
19113, huh?
Yeah.
Sorry about that. Okay, it's 113. Alright, correct. 33. And this is.
Everything else looks good.
Those numbers probably a little bit.
$2 difference.
$2 difference. Calculation. Right? Okay. Any questions so far? Any problems so far? All right. The next one is a little bit more complicated. So, but it's more like real life. Okay. Again, your company purchase a truck or any equipment. Okay. But this time, you don't pay one time. You pay every year. It's more like mortgage. It's more like mortgage. This is or some people say it's a lease to own. Lease. Doesn't matter you call this a lease payment or whatsoever. And this example you pay 3 years. All right. So let's see. It's on your page 480. Again, on a certain day, your company purchase a truck or any other equipment for 3 years. But it change a little bit. Okay. This time is 11% for 3 years, fixed rate, right? However, every year, by the end of the year, your company to pay 163,686. Very strange number, all right? 163,686 every year for 3 years. This is more like a reality. Very similar to your mortgage. The only difference is you don't pay monthly, you pay yearly, annually. All right? Of course, you can change the example to as a monthly, but right now we just want to simplify everything. All right, so let's write it down here. So that's the reason why I don't want to have your final exam. You understand? For my class, I try to avoid final exam. I prefer final project because I give me myself trouble to see your final exam. If I put this in your final exam and say close book, everybody give me the blank. You know? So try to stay away. I hope you understand. Then even you forget, then you just come back to see step by step. But you learn. At least you learn what's the present value, okay? All right, same in truck, but right now, what's the value of truck? By the way, everybody. What's the value? So you need to go back to page 8-2 to find out what is the present value factor of 11% for 3 years. So same thing. The value of this truck is not 163,686 times 3. It's not that one. So even though your company paid this number for 3 years, but you all understand this number including interest. So if you check page 8-2, this is called annuity. Annuity means the payment per year, right? Annuity. So the factor is not times 3, okay? It's 2.4437. Understand? I want to pause for a few seconds, okay? Making sure everybody can follow me. If you see page 8-2, you find out 11%, and you go down to 3 years, you see is 2.4437. Everyone understand? If the number is 3, they really mean today, right? They really mean you receive the lump sum not 3 years, but today. But because you cannot receive today, you receive 3 payments and 1 payment each year. So the number is less than 3. That's called present value. 2.44. Okay. So if you time 163,686 times 2.4437, and there's a 400,000 even. All right. So we all understand the value of the truck is 400. Everybody, I need your help. Can everybody do me a favor? You have 163,686 times 3. What's the total? What's the total payment you're gonna pay? If you have this number times 3, what's the total here? 491,058. However, for today, this is for today. Understand? So everything more than 400, you know that is the total interest expense your company is going to pay. Understand? But for today, for purchase date, you enter into this value for the truck. How about the other account? What is the other account? You have a 400 under the assets. How about the other one? No, same thing. Note payable, liability. So right now, again, it's assets match liability. Understand? Liability, note payable, 400,000. Here. Okay, for the first year, you pay 163,686. For the first year, you pay this number. The end of the year, you pay 163,686. How are you gonna do? Pay cash.
Credit cash.
Louder.
Credit cash.
Credit cash.
163,686.
Okay. How are you going to break down this? Because we know on the debit side, the total must be the same amount, but cannot be the same account. We need to break down. So we have what?
Interest expenses.
Yes, we have interest expenses, and also we have a portion go to note payable, right?
Payable.
But the problem is how to calculate. How to calculate?
Is that 11%?
11% is correct. Okay, right now you don't need to look at the back. Right now it's just a simple, very simple calculation.
Why is it?
So that is
4,000.
for 400,000.
400,000.
Right, 400,000 times what?
11%.
So that's what? I think this in the book.
That's 44,000.
44. Right, it's 44. So for the first year, we have interest expense. So this total number minus this, okay? You pay total 163,686. 44,000 is interest. So the rest is note payable. So can anybody tell me the number? It's in the book.
119,686.
6 what?
86.
No. So let me pause for a few seconds. So at this moment, it's okay? This number plus 44,000 equal to 163,686. So we have the cash, credit side 163,686. On the debit side, we have 44,000 as expenses, 119,686 as a note payable. So far so good, right? So far okay? For the second year, same thing. we need to break down again for the second year. So what is the interest expense for the second year?
It's gonna be the balance on the note.
Yeah, the balance of this. Okay, because balance every year you see is not 400,000 anymore, right? So for the second year is 4,000 minus 119,686. So what's the number? What's the balance for the second year in the book, right? Can you read me the number?
30,000.
Say it again. Say it again.
30,000.
30,
30.
30835.
308,
35.
31?
30,000.
No, that's.
No. I'm talking about balance. No payable balance.
132.
Yeah.
132.
Yeah.
851.
One what?
132.
Cannot be 132 because this one, unless this number is not right.
280,000.
No, what's the number in the book? You don't need to calculate by yourself. The number should be in the book.
Yeah,
No,
I
it's-
believe
it
it's,
doesn't. It doesn't show it there.
Oh.
It's just to give you a
One.
number.
Two.
So the number is
Should be 180 something, right?
280.
Or 280, right? This
Yeah,
on the paper.
and then 314.
Yeah. You use this number times 11% to calculate the second year interest. Can you read the number? The number is in the book.
30,800.
Yeah, 30,800.
35.
35. Okay. So whoever read me the number 30,000, that number is for the second year interest. So the balance applied to here is what? Here for the second year. Payable 163,686 total. However, only 30,000 to interest. So apply to note payable is what?
132.
132.
851.
851. This is for second year, okay? And for the third year, same thing. You pay 163,686. However, interest less and more. I'm sorry. Yes, every year you apply less to interest and apply more to the principal. Any questions so far? Any questions so far? I know it's not easy, okay? It's not easy. But the example number 2 is more practical, all right? If you can only learn something very limited, not everything, but for today, hopefully you can catch the idea of the example number 2. Any questions so far? Any?
Do we use the same table for all kinds of equipments?
Yes, doesn't matter the equipment. Right now we have 2 major things. One, if you use A1, okay, that is a one payment. That's one payment. I cannot figure out anything in real life. It's a one payment. I don't believe the lender gonna just wait for one payment. So I think the A1 is not really practical. A2 is more quite practical because you use the same thing to calculate your mortgage. Even for your individual, for personal, you use table 8H2 to calculate your mortgage monthly payment. Any questions so far, everybody? All right, so please write it down the day on board. Okay, and also in case you never received my email ever, come to approach me to correct your email in my file. Any other thing? All right.